Hi, this is chapter 4, and we're going to talk in this chapter about the cash and the internal control. I like to talk about this next, partially because it's in order and partially because cash is king, and keeping control of not only the cash but also the other accounting aspects of a company are huge, and you've probably heard about many of the scandals and the fraud schemes and so on and so forth, and this chapter addresses those issues. So just for fun, I went in and did a little bit of research, and I encourage you to do the same thing. I think this is kind of a cute little one that happened. It was very clever. It was fairly easy. There was a guy that was hired to maintain a jet it was a private jet for the CEO of this company called Cargill. Now, private jets are normally kept off-site of the headquarters, obviously, in some, remote part of the county or whatever. It was far away, and this guy was hired to be the mechanic for this private jet for the CEO. So this mechanic got really clever, and he says, I'm going to create a fake company, set up a P.O. box, and I'll start billing the company for any plane parts that are maybe even not needed, and I'll just pocket the money myself. That's what the plane mechanic was thinking. So he had sort of a kind of a credit line of sorts, or a purchasing limit of anything that was under $10,000. Didn't require anybody's signature. He just went ahead and ordered the parts to fix the plane. So he created, you can imagine how many under $10,000 plane parts that he quote unquote ordered, but really didn't order, from a fake company, and they paid out on these invoices for these plane parts that were not even ordered. Anyway, it was amazing how much money he walked off with. So the internal controls really would have prevented this from happening, because obviously there would have been some sort of second eyes placed on, did the parts get received that we just paid for, and where are those parts, and why is the plane always breaking down? Why are there so many parts that are always needed? That kind of thing. No internal controls. This guy just had basically a walk in the park, and so that's what can happen. Of course, he was later arrested. He can never find work again, so, crime doesn't pay, but this is an example of an internal control. Okay, another example was this accountant that was in their Albany, New York office for over 10 years. She was in charge of doing too many things. So she was able to create customer contracts, generate and mail the invoices that to do that, and then she received and processed the payments. So she could potentially create fake invoices for things that may or may not have been needed, and then pay for those invoices. And because there was no one in between her and her, she was able to get away with that. Anyway, apparently she got away with more than $25 million, which is absolutely incredible that it went on for that long. This type of internal controls, you may have heard of that before, is called separation of duty. All right, that was the big failure on this part, and I thought that was another interesting story for you. So just to get you, with the idea that internal controls, even though it sounds like super boring, it's actually really important to a company to maintain them. And moving on to probably two of the most high-profile cases are both Enron as well as WorldCom. So Enron used questionable accounting practices to avoid reporting billions and billions of dollars in debt and losses on its financial statements. On the other hand, WorldCom went ahead and misclassified certain expenditures to overstate them as assets and profitability to the tune of like $11 million. So other kinds of financial statement fraud include fictitious revenue, improperly valuing assets, hiding liabilities, and mismatching revenue and expenses, all in the name of trying to look better than they actually were. So obviously these two companies went under. The interesting thing is that with Enron, normally auditing, actually with both of them, standard auditing practices would have uncovered these. And in the case of Enron, the auditors, which were Arthur Andersen, actually did know about this and failed to report that. So even the watchdog was found to be guilty in this case. And in WorldCom, that's actually how they found the fraud to begin with. So, all right, let's move on. One of the things that was handled in terms of responding to these large corporate accounting scandals, which also caused a huge amount of public outrage. This was years ago, so you may not know about this, but these were the hugest fraud times of their day. Of course, there's been other things that have happened since then, but this was really the start of Congress wanting to get involved in passing what was called the Sarbanes-Oxley Act of 2002. So obviously a couple of years ago, right? But what this does, it's called SOX, S-O-X for Sarbanes-Oxley. All right, so we know that now. It applies to all companies that are required to file financial statements with the SEC. In other words, every public corporation. And it was one of the greatest reforms in business practice. It acts to establish a variety of guidelines related to auditor-client relations, and also what management is responsible for and what internal control procedures should look like. So these are the highlights of SOX, and I don't anticipate that you'll really have to know all of these, but as it relates to Chapter 4 here, we've got these internal controls down here, right? And that just says that the company management, they're basically responsible to make sure that there's internal controls in place. Okay, so all right, just wanted you to know about that. Okay, so what are the components of internal control? In other words, how do we internally control ourselves? So there's monitoring, and then there's control activities to make sure that the directives are being carried out by the management. This is like, authorizations, reconciliation, separation of duty, which are a couple of the things that we mentioned when I talked about some of the other interesting fraud cases at the beginning. Risk assessment, what kind of risk factors are there? And then the control environment. So what's the overall tone of the company? What are their ethical standards? So these are this is the basic pyramid in which internal controls are built upon. All right, so what is separation of duty? What I did is I kind of broke this down into a movie theater, because who doesn't love a good movie? All right, and we've all been to a movie theater. So what does separation of duties really mean? Well, as it pertains to a movie theater, that means that the person that is selling the movie tickets should not also account for the cash at the theater. Similar to, like, even breaking that down even further, the person that sells the tickets for the movie maybe should be a different person than the person that actually lets the person into the theater, right? So we always know we go to the box office, we buy a ticket, we go into the theater, and there's a separate person that's taking the tickets. So that's a good example of separation of duties. But then a third stage really is the person that's selling the tickets shouldn't be the person that's responsible for counting the cash at the end of the day. So what is the person doing at the end of the day? They're counting how many tickets did I sell? How much cash or credit cards do I have that have come in? And hopefully those two balance themselves out. Okay, physical controls. So when I was a bank teller, I was responsible for millions of dollars of cash, and there was literally a physical control that was put in place by the bank, and every bank usually has this, is that there's always two people that go into a vault where the millions of dollars are stored, and one person has one key and one person has the other key. You can't open the vault unless both people are there and they sign off for things, but that's an example of physical control. All right, proper authorization as it comes to the theater. Again, back to the theater. Only theater management should be authorized to make purchases for popcorn, right? Popcorn supplies over a certain amount, right? So if they just need, if they're just ordering another case of soda, syrup, or whatever, maybe that's under a certain dollar amount. But if it goes above a certain dollar amount, then they've got to have a secondary line of authorization for those purchases. Okay. Employee management, obviously, there's always a manager on site, and they're just making sure that all of the controls that have been set about by the movie theater are being followed. And then they should make sure that, as every company should, that there are firewall settings so that no one can come in and hack their computer systems, get their credit cards, and so on and so forth. I could go on for a long time because I also teach an information systems class about this e-commerce control, because we know that cybersecurity, which is something that you've heard a lot about, is a huge issue, and every company that's online, which is basically every company, needs to have internal controls for their cybersecurity systems. Okay, so anyway, I won't get into that. I will just keep moving. And reconciliation should mean that someone's got to true this stuff up. How much money have I taken in? Has the right amount of merchandise been decreased from my inventory, and does my cash reflect the amount of money that should be in there based on what's in my inventory, and so on and so forth. So that's a reconciliation. Okay. And then obviously audits, meaning that someone third party, not related to the people that are in the day-to-day operation, should come in from time to time. And if it's a publicly traded company, this is a required mission, and just make sure that everything balances out as they say it has. Okay, so there's obviously limitations of this. People could get together and say, hey, if you sell the movie ticket and I let them in, then we can split the cash if we just put it off to the side, or whatever. There's all sorts of collusion that can be involved. And that obviously the internal controls would be thrown out the window, but hopefully with a good audit, those kinds of things would eventually be captured. So in other words, crime does not pay. I'm pretty sure I said that earlier. Okay, let's talk about my next subject, and here's my
3 million cash. Call me Rain Man. Money like a shower. That's my rain dance.
That's about all I could play with that song, and still get away with playing that song at all. Let's move on, because we're going to talk about cash. Okay, my favorite little thing, because who doesn't love cash? All right, now what we're going to talk about is, what is cash? Okay, you and I may think we know what cash is, but it's basically the green stuff as well as the change, any checks, savings accounts, checking accounts, credit card sales, also considered to be cash, as well as debit card sales, and anything that looks like cash. Okay, so this credit card sales, even though we may think that would be kind of on account, it's not. It's actually credit card sales to us. Let's say we're the movie theater. Anybody that charges a movie ticket on their credit card to us as the movie theater is still cash. Why? Because the bank is going to give us that much money as soon as we turn it in the next day. Okay, so we have internal controls for both cash coming in as well as cash going out. Okay, so these are some of the internal controls for cash coming in, and these are for cash going out. And I'm not going to get into that too much. You might see a multiple choice question conceptually on these, but you don't really have to memorize all of those different things. Okay, so let's talk about bank reconciliation. Now, you and I probably both have some sort of a checking account, and maybe we write checks, although that's not as common as it used to be. But certainly for a company, unless they're completely electronic, they still may write checks from time to time. And certainly they're always going to have cash coming in and cash going out, similar to you and I. I don't care if you use PayPal or Venmo instead of writing a check, you've still got money going out, and you may have a paycheck coming in. So we will hopefully be able to reconcile the balance in our checking account. And this is the whole idea behind this next topic. So we're going to start with the bank's balance and then our balance, and we're going to try to true those things up. Now you may be thinking to yourself, why are those even different? Well, it's probably a timing thing. So let's say, for example, a company sends a deposit in the mail to the bank. This is because banks or the companies probably don't use that electronic deposit feature like you and I have, right? So they may send a deposit in the mail. So they've recorded that, hey, we've made a deposit. They increased their balance in their checking account. But on the other hand, the bank hasn't received that deposit yet. So you can see that there might be a little bit of a timing difference, and the bank hasn't increased your balance by the amount of that deposit because they haven't gotten it. All right, so we're going to start with the bank's balance, which was on the bank statement, which we received either in the mail or electronically. And then we're going to look at our cash balance, and we're going to try to true those things up. That's the whole idea behind this bank reconciliation. So what are the things that we're going to adjust the bank's balance for? Whoopsie daisy. Okay, so we're going to add in to the bank's balance any deposits that we have increased our balance in our checking account for, but the bank hasn't received yet. So if the bank hasn't received a check that we're trying to deposit, then obviously, we need to add that so that we can figure out if the bank has the right balance. Okay, then we're going to add in or subtract out, depending on which way it goes, any bank errors and any outstanding checks. What the heck is an outstanding check? An outstanding check is a check that we have written, but whoever we wrote it to hasn't cashed it yet. So obviously the bank can't subtract that check yet because they don't even know that that check was written. So we have to subtract that from the bank's balance and any bank errors, and then we come up with an adjusted bank balance. Now on the other hand, our balance, we're going to add in any collections the bank made on our behalf. Maybe somebody's repaying us a loan, for example, and they're the third party that goes in between us. So any bank collections that they have made on our behalf, any other electronic receipts, revenue, any book errors, we either add or subtract those depending on which way the error went. And then we subtract any NSF checks. What's an NSF check? An NSF check means non-sufficient funds. Okay, that means that somebody wrote us a check for $100 or whatever, and we go to cash that thing, and we put it in our bank, and we're all happy, and we increased our bank balance, our book balance by $100. That check goes off to that person that wrote us, and that bank that other person banks at says, you know what, this person doesn't have $100. So what happens is it comes back to us, and the bank goes, hey, you guys, that loser didn't have $100 in their bank account, so then our bank account gets reduced by that $100. So that's what an NSF check is. So the thing I want you to take away from this is that there's things that we add and subtract to the bank, things that we add and subtract to our balance, and then hopefully those two will equal. That's the name of that game. So here's an example of a bank reconciliation where we start with the bank. We start with our books, we add and subtract things from the bank side, we add and subtract things from our side, and hopefully the adjusted balances will be the same. You're going to get lots of practice on this. So here we go. Here's an example of a company, and this is what their, what am I trying to say? The bank statement looks like. Okay, so here's our account number, here's the statement date, yada yada. All right, so we have an ending balance we had a beginning balance, and then we have a summary of how many deposits or credits were made and how many withdrawals, and then we have an ending balance. Here's the breakdown, so we see that there's a deposit, a note, another deposit, and some interest that the company or the bank increased our balance by, and then there's some other things that were subtracted. So here you can see that Well, we wrote check number 293 and they took it out of our account. 294, same thing. Here's an electronic funds transfer. Maybe we had an automatic, payment for something or other. And here's an NSF check. So somebody wrote us a check for $750. We increased our balance for it. Then that check came back as no good. So that check has to come out of our balance. Here's another check. Here's something else. Here's a service fee. Altogether, there's $8,300 in withdrawals and debits. There's our ending balance. Here's a running balance. So that's an example of what a bank statement may look like. And then here we have our records as the company. So these are the deposits we think we made. Here are the checks we think we wrote. And then there's our ending balance. So wait a minute. What did the bank think we had? 4,100. We think we have 28.8. Do you see that we need to reconcile these two things? We're like, what the heck? How did those things become different? So I put them on the same page for you. Isn't that great? Here's the bank's ending balance. Here's our ending balance. And we're going to go through and we're going to take things from the bank balance, like any deposits that are outstanding. In other words, we made a deposit but the bank hasn't gotten it. Any checks outstanding, checks we've written that haven't been cashed, bank errors, blah blah blah. Okay, so that's what we're going to do. Okay, so what I've done here is I've put down that per the bank, they think we have $4,100. And what they haven't noticed is that there's a deposit that we are trying to make, but we've also written a couple of checks. So if you reconcile those two things, it would come up to $4,200. But then on the company side, we didn't know that the bank collected $2,800 from us, that we didn't know that they had given us interest of $200 from the note, and then they gave us $20 from the bank account, but then we didn't know that there was an NSF check, so we're going to subtract that. Here's a debit card transaction, here's an EFT transaction, there's a service fee, and there's a rent expense error. In other words, we wrote down our check amount wrong. And so anyway, if we take all of these things that we just discovered as a result of getting our bank statement, and then we true up a couple of things that the bank didn't know about, you can see that those balances actually equal the same thing. So I put this back up here again so that you can see that what I basically did is said, okay, there's $3,600 that the bank received, and yep, that was a deposit I made. And then there was another deposit I made for $1,980. They didn't get this $2,200, so I'm going to kind of add it into their bank balance. And then I look at this and I go, oh, they collected $3,000 of a note, so I'm going to add it to mine, right? Do you see how I'm kind of truing those things up? Over on the withdrawal side, we can see, yep, there's check number 293 for $2,100. That checks out. Rent $2,900. Oh, wait a minute. I wrote it down for $2,600. It got cashed for $2,900. That's where that $300 difference was made, and on and on and on. And here was a service fee that we didn't know about. We're going to have to subtract that. So there's things that the bank did on our behalf that we have to reflect in our own account, and then vice versa. There were things that happened in our account that we have to reflect in the bank. All right. Hence, bank reconciliation. Okay. Some common things that happen, and then as a result of transactions that occurred on the bank side, we may need to make some journal entries. So for example, do you remember they collected on a notes receivable for us, so now we need to increase our cash by both the amount of the note that was collected as well as the interest that was collected on that note. And then here's $20 in interest revenue. So altogether, we're going to increase our cash by this. So there is a journal entry that we need to make as a result of reconciling our bank statement. Okay, here's some things that decrease cash. So you can see that a credit is made to our cash account. Why? Because we have to we got an NSF check, so we have to put that back in accounts receivable. Why accounts receivable? Because somebody owed us money, they paid us a check, that check went bad, we have to then put it back in the accounts receivable saying that, hey, they didn't really pay us. All right, here's some other things, other expenses, so on and so forth, and then again we credit that cash. Okay, so that is that part of the bank reconciliation, and you're going to have to do a couple of those exercises in your homework, as well as you'll see that on the exam. All right, so the statement of cash flows is basically where did the cash actually come from and where did it go to. So there's the operating section of the statement of cash flows, and there's also investing portions of the statement of cash flows and financing activities. So those are the three basic sections of the statement of cash flow. So the statement of cash flows actually focuses on one thing and one thing only, and that's cash. Where did the cash come in? Where did the cash go out? And what sections or what type of activity was that? Was it an operating activity involving revenues and expenses? In other words, what's the regular everyday part of what I do as a business, and that's my operating section. Investments are things that I make as an investment in the company, like do I buy a long-term asset? Do I buy some securities? Like that kind of thing. And those things will both increase and decrease depending on what kind of an investment activity. So if I am buying a new piece of equipment, then my cash is going to go down because I had to pay for the piece of equipment. If I sell that piece of equipment, well, guess what? My cash is going to go up because I sold that piece of equipment. Somebody gave me some money for it. Okay, and then financing activities are things that I do to increase my cash that comes into my company that I'm going to use to finance my company. How do I pay for what I'm doing, right? So that is either borrowing and or issuing stock to increase my ownership. Okay, so and again those come in as increases, go down depending on what the transaction itself is. Okay, so here I've given you some examples of transactions and what kind of an activity it is and whether it's an inflow or an outflow. So if I if I sell common stock, you say that fast 5 times, for $25,000, then what kind of an activity is that? It's a financing activity. Is that an inflow or an outflow? It's an inflow because people gave me $25,000 and I issued stock. So if you look back on this screen really quick, you can see that transactions designed to finance the business through either borrowing or owner investment, which is stock, right? Those are ways that I bring money into my company. You can see that selling common stock is a way of financing my business, and it's an inflow. So I encourage you to go through these things and see if you can make sense of the type of activity and whether it's cash coming in or cash going out. This is a statement of cash flows, so it basically says what are my inflows, what are my outflows, and what is the cash that's at the very ending. Okay, so here are a couple of concept checks for you with the answers so that you can tell if you got things right. Okay, so that is the end of chapter 4. Thanks for watching.